welcome to everything you need to know about finance. Now, before we really jump in, just a quick but important heads up. This deep dive, it's all based on publicly available data and our analysis of it. It's definitely not financial advice, so any investment decisions you make, please base them on your own research, maybe chat with a qualified financial advisor. Okay, so today we're digging into a company pretty much everyone knows, Apple Inc., ticker AAPL. We're focusing on their second quarter fiscal year 2025 results. We've got the earnings release, the official Form 10Q filing, basically the core documents. And our goal here is really to pull out the key stuff, give you a clear picture of how Apple's doing, financially.
Exactly. We have Apple's Q2 2025 press release, that detailed 10Q filed with the SEC for the quarter that ended March 29th, 2025, plus some general company info. And yeah, our job is to kind of sift through all this and really pinpoint what matters in these reports.
All right, let's get into it then. So Q2 fiscal 25, Apple's reporting revenue of $95.4 billion.
That's the number. And it's up 5% compared to the same time last year.
Okay, 5% growth. And what about the bottom line? The earnings per share, the EPS.
Diluted EPS came in at $1.65. That's an 8% increase year over year.
An 8% jump. And I think I saw that was actually a record for their March quarter.
It was, yeah, a March quarter record, which definitely suggests some underlying strength, doesn't it? Especially considering, the wider economy.
Right. And you mentioned something else that jumped out, the services revenue.
Double-digit growth there. That's a huge piece of the story we need to unpack. It says a lot about how Apple's business is evolving.
Absolutely. And the leadership comments, they add some color too. Tim Cook, the CEO, he talked about the strong results, obviously highlighted that services growth, and also mentioned new products, the iPhone 16, new Macs, new iPads with Apple Silicon.
Right, keeping that product pipeline flowing.
And interestingly, he also threw in a note about reducing carbon emissions by 60% over the last decade. Not strictly financial, but it gives you a sense of their wider focus.
Yeah, and mentioning those new products, the 16, the Macs, iPads, it underlines that they're still pushing hard on innovation, defending their market spot.
Good point.
And the carbon emissions thing, well, that reflects what investors and, frankly, customers expect now regarding corporate responsibility.
True. Then you have the CFO, Kevin Perrick. He echoed the 8% EPS growth, mentioned a hefty $24 billion in operating cash flow.
Which is the cash from their main business, yeah.
Exactly. And pointed out they returned $29 billion to shareholders just in that quarter.
A massive return.
And he also noted their installed base of active devices hit a new all-time high. What does that increasing base really tell us?
Well, it's critical, right? It shows that ecosystem is sticky, people are staying in. It means a built-in audience for upgrades, yes, but maybe more importantly for all those growing services they offer. Suggests they aren't just relying on selling you a new phone every year.
Good point.
Right.
And talking about returning value, they bumped up the cash dividend by 4% to 26 cents a share.
Payable mid-May, a direct return for shareholders.
And on top of that, authorized another $100 billion for share buybacks. That's a huge amount of capital being deployed.
It really is. The dividend gives income. The buyback, well, it can support the stock price by reducing the share count. It also signals maybe the company thinks its own stock is a good buy, and they clearly have the cash to do it.
Okay, let's break down where that revenue came from. Products brought in $68.7 billion. That's up a bit from $66.9 billion last year.
A modest increase there.
Within that, iPhone was up slightly driven by the Pro models, it seems.
The higher end.
Mac revenue also grew, both laptops and desktops. iPad saw a bigger jump thanks to the new iPad Air.
Right.
But wearables, home, and accessories actually went down a bit from $7.9 billion to $7.5 billion.
Yeah.
Any thoughts on that mix?
Well, it shows things aren't uniform, Strength in the premium iPhones, Macs, iPads is good news. The dip in wearables could be timing of new releases, maybe more competition there. Hard to say for sure from just this. But yeah, performance varies across the product lines.
And then the big one, services. As we said, impressive growth, $26.6 billion, up from $23.9 billion, driven by advertising, the App Store, cloud services. This really feels like the engine now, doesn't it?
Oh, absolutely. It's central to the narrative. It diversifies revenue away from just hardware cycles. And crucially, services tend to have much better profit margins. That really helps the bottom line.
Speaking of margins, overall gross margin improved slightly to 47.1%.
Up from 46.6.
But here's the interesting part. The product's gross margin actually dipped a little to 35.9%.
Down from 36.6%, yeah.
While the service's gross margin jumped up again to 75.7%.
Wow, yeah. That difference is stark. It really shows how much that services growth is boosting overall profitability. It's offsetting the slight dip on the product side.
Okay.
Investors tend to like seeing that shift.
Makes sense. Now, operating expenses, both R&D and SG&A were up. Research and development hit $8.6 billion, dollars,
Up from $7.9 billion.
and selling, general, and administrative costs rose to $6.7 billion. Dollars. Is that increased spending a red flag?
Not necessarily. Higher R&D spending is often seen positively investing in the future, new products, innovation. A modest rise in SG&A isn't unusual for a growing company. You just need to watch that it stays efficient relative to revenue growth.
Okay. And all that nets out to a net income of $24.8 billion, dollars, up from $23.6 billion dollars last year, which leads back to that $1.65 EPS figure we started with.
Right, both basic and diluted EPS were $1.65, up from $1.53.
Now let's look geographically. How did sales break down around the world? America saw a solid 8% growth.
$40.3 billion there. Pretty strong.
Europe was up, but only slightly 1%.
Okay.
Greater China, though, was down 2% to $16.0 billion, reportedly hit by lower iPhone sales there.
Yeah, that's a key market. So a dip there is definitely something to note. Could be local competition, specific economic factors.
Japan, on the other hand, had a huge jump, 17%.
Wow, yeah, $7.3 billion. Very strong performance in Japan.
And the rest of Asia Pacific was also up 8% growth, hitting $7.3 billion as well. So a bit of a mixed bag globally.
Definitely. Strength in the Americas and Japan is great, but that dip in China is significant and will be watched closely. The other regions help balance it out, though. Diversification helps.
Shifting gears to the balance sheet. End of March. Cash and cash equivalents were down a bit from September.
$28.2 billion versus $29.9 billion.
Marketable securities also decreased overall. Total assets are down, total liabilities are down.
But interestingly, total shareholders' equity is up from $57.0 billion in September to $66.8 billion now.
So less cash, fewer securities, lower assets and debt, but higher equity. What's the story there?
Well, the cash and securities decrease likely reflects them using that capital, right?
Hmm.
For the buybacks, the dividends, investing in the business. The equity increase, even with those outflows, points to their continued profitability. And the share buybacks, reducing the number of shares outstanding, also boosts equity per share. Lower liabilities is generally a good sign, too, a stronger financial footing.
Okay, let's look at cash flow for the first 6 months of their fiscal year. Cash from operations was actually down a bit compared to last year.
$53.9 billion compared to $62.6 billion. Yeah, could be working capital changes, various factors.
But cash from investing activities was way up.
$12.7 billion generated versus only $1.6 billion last year. Maybe selling off some maturing securities, perhaps.
And cash used in financing activities also increased. $68.4 billion used, up from $61 billion. And that includes nearly $50 billion just for share repurchases, plus over $7 billion for dividends.
Right. That financing outflow directly shows that strategy of returning cash to shareholders. It's a huge, deliberate use of their funds.
Now, beyond the pure numbers, there were some other key things mentioned. Those new products launched in Q2.
iPhone 16, the iPads, Macs, yeah.
Ongoing worries about macro conditions, inflation, interest rates, currency swings.
Always a factor for a global company.
Plus, new U.S. tariffs announced in Q2, potential for retaliation that could hit supply chains, costs, pricing.
Well, definitely a risk factor to monitor.
And then the legal stuff. The Digital Markets Act, investigations in the EU, the big DOJ lawsuit in the U.S., the ongoing Epic Games case.
Right, regulatory pressure seems to be constant. They even got fined $500 million in one EU case, though they're appealing.
And they finally settled that big Irish tax issue, releasing the funds from escrow.
Yeah, $14.2 billion. Settling that removes a long-standing uncertainty, at least. That's a pretty long list of external pressures and events.
It really is. It highlights the complex world Apple operates in. New products need to hit, macro factors matter, tariffs are a potential headache, and the legal battles could have real financial and operational impacts.
Absolutely. Success hinges on navigating all of that effectively.
So we've walked through the numbers, the leadership comments, the external factors. What's the bottom line here? What does this all mean for you, our listener, trying to get a handle on Apple?
Well, I think what stands out is this balancing act. You see continued growth, especially in that high-margin services area. That's key. And at the same time, they're aggressively returning capital to shareholders. That installed base hitting a record high, it just underscores how sticky their ecosystem is.
Right.
But you absolutely have to keep in mind the potential headwinds, the economy, those trade tariffs we mentioned, and definitely the ongoing legal and regulatory fights. And keep an eye on performance in Greater China. That's still a really important market for them.
And thinking about the stock's future, that huge $100 billion share repurchase authorization is significant. It could provide real support for the stock price.
Potentially, yes, by reducing supply.
And the continued strength in services offers that more predictable, high-margin revenue stream investors often value. So key things to watch going forward will be how well the new products sell, that iPhone 16, the new Macs and iPads, and of course how Apple manages all that regulatory scrutiny around the world.